Welcome to The Chemical Show, the podcast where chemical means business. I'm your host, Victoria Meyer, bringing you stories and insights from leaders driving innovation and growth across the chemical industry. Each week, we explore key trends, real-world challenges, and the strategies that make an impact. Let's get started. Welcome back to The Chemical Show. This month, I am continuing on our theme around sustainability and innovation, and with a number of great guests, including today's guest, who you're going to hear a little bit more about very soon. If you are new to The Chemical Show, make sure that you hit the subscribe and follow button on whatever podcast player that you're using, and head over to thechemicalshow.com where you can get a lot more information, including a whole write-up on our blog, more information about what we've done. It's a great place to search for past episodes because, again, we have over 200 episodes published and lots of great interviews with lots of great executives. Today, I have the opportunity to speak with my friend, Kendall Justiniano, who is the founder and managing director of GrowthArc Advisors. So, GrowthArc and Kendall help chemical clients and material clients find untapped growth opportunities through expertise in sales and marketing, value and growth, and strategic transformation. Kendall comes to this with a career of over 30 years at leading companies, including Dow and most recently W.R. Grace. So we're going to be talking about sustainability and innovation, some of the challenges, opportunities, and the new directions that we're going. So, Kendall, welcome to The Chemical Show.
Victoria, thanks so much. It's great to be here with you today.
I'm so glad to have you here. Let's talk about your origin story, because you know I love to start there.
Yeah.
What actually got you interested in chemicals, and how did you get to where you are today?
I think for me, I don't think there was any other place that I was going to end up but chemicals. That might sound strange, but I've got chemical engineers and chemists in my family. Chemistry was a love since high school. It was always going to be a chemical play for me in my life. But I spent 25 years on the commercial side of the chemical business. And I think the one thing that's unique about my career is I'm a generalist, right? So I've done sales and marketing, product management. I've seen a lot of different industry sectors and segments. And I've operated in a bunch of different scenarios: specialty, commodity, high growth, and even turnaround and divestments, right? The one thing that I honed over that time, and I think that I've come to be known for, is first off, when I get into an industry, a particular problem, it's really fundamentals analysis, going back to the fundamentals of what's going on in that particular context, and an ability to take that and read the tea leaves and do something with it. For instance, when I was at Poly1 Avient, I was one of the early champions of composites, of us getting into composites. That business is now 25%, almost a third of Avient's revenue.
Wow.
And so that's the kind of thing I've been known for. They haven't always been successes. Sometimes they've been like, no, we got to shut it down, guys. But that's the thing I've done. I think part of that was because of this generalist thing. Right. I've seen a lot of different places and I'm not tied. I didn't develop my intuition around a single context, but it's also because I didn't start in commercial. My first 6 or 7 years in the industry, I was in operations. I was doing capital deployment, and I did one assignment as a finance analyst. So I have a close tie to the technology. Again, chemistry is in my blood. I'm not going to ever get rid of it. Close tie to the technology and a real understanding of what it takes operationally and from a financing standpoint. And you put it all together, and it's sort of our superpower where we come from is the fundamentals of business growth, right? How do you do business growth? And that's one of the reasons I decided to form GrowthArc Advisors. I took around when I was looking for my next opportunity, and I looked at the crystal ball. And you were there, and I said, look, growth is going to be tough to come by in the future. That's my bet, and leaders are going to need help. And so we decided to go off on our own and specifically specialize in helping chemical leaders with growth.
I love that. And I think you're right. And I think, Kendall, you and I have some parallel experiences in our career, starting in manufacturing and projects and moving through a wide variety of just different commercial roles and manufacturing roles and project roles. And it gives you that great lens for how business is really done, right? Because
Yeah.
A lot of times it's easy to have if you stick in one space, you kind of have blinders, right? You only know what you know.
Yeah.
The good news, bad news thing of being a generalist is you know a little bit about everything, which is a great opportunity, and it can also be a pain in the butt.
Yeah, I mean that's the potential downside. The thing that I learned is as long as you stay to the fundamentals,
Yeah,
you're always going to figure it out,
yeah,
right? You're always going to figure out how it works in this particular context.
yeah.
So,
Love that. So, we're sitting here in the first part of 2025. Our focus here today is really around sustainability and innovation, and the views and discussions on sustainability have dramatically changed, right? If we go back to the beginning of
oh
the
yeah,
decade, it was rah, yeah, we're shooting for the moon. There was big promises, big goals, net zero by, my gosh,
yeah,
2025 was some
yeah,
of the goals, or 2030 or 2040, depending on where you sat. And along the way, we figured out it's really stinking hard. Not
yes, we did.
not sure how we make it profitable. How do our
Yeah,
customers, and it's easy to say, "Oh, I want a sustainable product." Oh, well, your sustainable product's going to cost 10 times more. Well, maybe not.
yeah,
So
yeah,
so a big shift. And yet, there is still a sustainability imperative. Right. So I think there's no doubt about the fact that people want to continue to improve the world, leave it a better place, be
yeah.
mindful of carbon and greenhouse gas emissions and all the other things. You're talking to a lot of industry executives. What are they saying? What do you see happening and why?
Well, I echo your sentiment, and these are some really wild times. I'm not sure I've seen times like this in my career, right? And it's been a pretty long career. If you look around, it sure looks like a lot of people are pulling back from sustainability. You see majors like BP, right? They just announced a whole re-emphasizing and sort of pulling away from their renewable energy initiatives. Companies like BlackRock in the financial sector, they were one of the guys who originally kicked off this whole ESG sustainability investing trend, and they're struggling. There's a lot of talk about maybe sustainability and financial returns don't actually go hand in hand, and that was the original premise of why financiers started investing.
Right.
And we were just talking a little bit ago in the green room. I'm in Europe now, and what you hear here, and a lot of industry leaders have already spoken up, is look, you can get decarbonization, but you're probably going to get deindustrialization at the same time. Are you sure you really want that?
Yeah.
Right? Because now you're talking about impacting the standard of living of people in order to get to these lofty goals. And even if you look at trends with our customers, like I follow the auto industry for a long time. Let's set Tesla and some of the political stuff aside. The rest of the auto industry is still trying to figure out how to make money from EVs.
Yeah.
And this is after spending billions of dollars of investment. So it can certainly look pretty scary in terms of, hey, what's really happening with sustainability. I think before you get into the dynamics around sustainability, you have to look at kind of the economic context in materials today, right? Where do we sit? Where do we stand? And what is the outlook, just as you're talking about chemicals? And from our perspective, I think we are, and you start to hear this as I talk to executives, right? We're a third of the way in to one of the longest down cycles you've ever seen in the chemical industry, right? It may be precedent setting even in my career. We've been around the chemical industry long enough, Victoria. We thought of it as a cyclical industry,
Right.
right? Every 5 years, you'd get a little overbuilt, a little aggressive, and then you'd have to cut back, wait it out, right? And then the industry would come back. The reality is we haven't really seen a down cycle in 20 years. And a lot of that was fueled from Asian growth, right?
Right.
So China's growing double digits. They need materials. There's a crazy amounts of construction. You see these things like, skyscrapers built, and you've got 25-year backlog of empty buildings waiting to be filled. And miraculously, 5 years later, they were filled.
Right.
And so, from our perspective, a lot of what's happened is that China growth story is over. Their real estate sector has imploded. We now know they've overbuilt their materials sector, right? And we've got a significant amount of excess capacity in sort of core chemicals. And a lot of that was happening pre-COVID, right? I think the industry got caught a little bit flat-footed. First, there was COVID, right? That what was happening, and so everybody pointed to COVID. And there was all of the logistical issues that came along with COVID, and sort of sorting that out. And I think it's become pretty clear at this point that that Asian growth story is over. They've had flat growth in China for several years now, and you've seen now what global commodity prices are looking like. I came from polyolefins. It's pretty ugly.
It's grim
right now. I think as a context, the industry's dusting off what you and I probably knew as the down cycle playbook. What do we do in a down cycle?
Right.
Right? We got used to knowing how this worked. Every 5 years or so, we're going to run a down cycle, right? You start to see rationalizations happening. You see things going out for sale. That's after companies are reporting losses. Then you see focus on cash, limited capital, probably some headcount reductions to get your cost structure in place. And you waited it out, and it eventually came back.
Yeah. Well, and I think, Kendall,
I talk to clients. Go ahead.
So I'm going to jump in and say,
Yeah, go ahead.
one of the things I've seen is that if you look at our current leaders, so, you talk about it being a 20-year upcycle, and it's been approximately that, right? It's been a really long upcycle, and now we're going to enter this really long down cycle. But we have a lot of business leaders that have never actually managed or led through a down cycle. Yeah. Maybe they were, maybe they weren't even in their work career yet. They were in college, or maybe they were in the early days when, and I don't know about you, but I didn't actually understand what was going on in the business when I was working in manufacturing as a young engineer. I tried, but I didn't. There was we'll get into that. That's a different story. There was a few things I called, BS on related to sales guys when they would tell me some stories, but you didn't really understand it because you weren't dealing with it. You were just executing and not making the decisions. So we've got a whole set of decision makers that haven't necessarily had to make decisions in these environments. Yeah. I think it's interesting that you talk about pulling out the playbook. I was at SOCMA recently, I guess it was in February. And of course, SOCMA is focused in on, it's mostly specialty, custom manufacturing, toll manufacturers.
Fine and custom,
They're actually feeling pretty solid because they know that part of the playbook is when the big companies have to downsize, have to tighten their belt, have to focus in, the opportunity comes up for that part of the market. And so I think there's just some interesting nuances that take place.
It certainly is completely contextual, right? If you know the fundamentals, you can figure out where you are at and how those fundamentals play out for you.
Yeah.
Right. I have a funny story. I've got the same kind of thing. I've got clients. I was talking to a CEO the other day, and he is of the same age that I am, and he remembers the playbook. He remembers that it was run. I wasn't a leader at that time either, but his entire operating staff has not been. Almost all of his people have not been through. And if you remember, the mantra of the day was first into the cycle is first out to the cycle. The guys who saw it first, who reacted first, didn't end up hemorrhaging as much cash as some of the other companies did. And they were the ones who were setting themselves up to be the ones to come out healthiest in the back of the cycle. Yeah. So if you know that, you say, okay, first in is smart. If you've never experienced that before, you say first, oh my God, what are they what's doing? Happening to us? And what's going to happen on the other side of it? And I think that's part of what we're dealing with. Part of why we got caught a little flat-footed for those basics.
The other mantra that comes to mind with this is cash is king, right? And that was something that really came out early on, was cash is king. And I didn't fully understand it, but we executed the playbook because I was helping to run the playbook. Mm-hmm. But I certainly see that now. It's an interesting dynamic as an entrepreneur, like. Cash is king because I'm running my own books and I'm not relying on somebody else to cover my take, so to speak. You got to do it yourself. So I think this whole aspect is interesting. So when we talk about sustainability, though, do you see that companies are still interested, right? So, there was this jubilance. Now we're in an economic downturn. There's a pullback. And you're sitting in Europe, I almost would say the initiator of a lot of what we're targeting in terms of the net
Yeah.
zero and net zero by 2025 or 2030, or, pick your poison.
Mm-hmm.
Are
Mm-hmm.
companies still interested in sustainability? What are they saying?
I think the short answer is yes. I mean, thinking back 5 years, those were heady times in a sense, right? And everybody was getting pretty excited about the potential here, right? Sustainability became the key innovation investment, if you will.
Yeah.
Everything had a sustainability angle. What you're seeing right now is a weighing of the trade-offs. So in Europe, right, we're starting to sort out what does this really mean, and does Europe continue on its path, or does it have to modify that in some way? And that discussion, I think, in a lot of ways, is just beginning. But what you see other places is that first effect of rationalization, right? Rationalization is not, oh, we're stopping. Rationalization is not everything is affordable as it was a couple of years ago. We've got to pick our investments carefully. It's a pruning, if you will,
Mm,
right? Plants get healthier when you prune them back. Essentially,
true.
I have an optimism for the industry, but what you're going to see right now is that type of pruning.
Yeah. It
And I
feels
think a
like
lot
Europe
of
is
it,
getting
go
heavily
ahead.
pruned. You use that term rationalization, and there's rational as in let's be logical and rational. And then, of course, we often use rationalization to say, man, we're shutting down a whole bunch of assets. And is the mood gloom and doom where you sit?
I mean, I think the key leaders, some of the key leaders. So Jim Radcliffe is one I look to. Ilham Kadri at Science Co. just was on the European. She's now leading the European Manufacturers Association. They've got to be sounding the alarm bells, right? Because once you get to a point of rationalization, you're done,
I
right?
mean, it
There's not
kind of
much you
feels
can
like it's
do
too
after
late
something
almost.
has
And
been shut down.
right. It feels like it's
Yeah,
too late in some
yeah,
ways.
and so yeah, and so they're setting off those alarm bells, right? And I think that's going to be
Yeah.
good, and that starts a healthy dialogue. The other aspect is when we talk about sustainability, we don't think of it as a single, uniform type of thing. Sustainability has a lot of different types of plays associated with it. There's a lots of different directions for sustainability, and the fundamentals are different for each one. So each one has its own dynamics, and each one's going to react a little bit differently to what's happening right now,
Yeah.
right? So for me, for the question, are companies still interested? I would say yes, but in a qualified manner, right? Does it make business sense? And the devil right now for sustainability is in those details. For some, it'll be yes, and for some, it'll be no.
Yeah. And I think some of it is, I think this, if I go back to, the heady days of sustainability in the early 2020s, it was around new products, new
Yeah,
innovations, new what have you. And yeah, and we talked about this a little bit before we got started
yeah,
here is I view the chemical industry and many industries has been inherently circular kind of forever. Why? Because it's efficient. Maybe because it's cheap. Well, instead of sending this stream to waste or to the flare or to whatever, can I make another product
yeah,
out of it? So if you look at how much of the industry, in fact, even chemicals themselves, are often made from kind of the byproduct bottom streams coming out of oil refineries, right? So there's a lot of
yeah,
inherent circularity and sustainability that take
yep,
place in that. But it gets
yeah,
into, Kendall, I think, just these different risk profiles. And I think companies right now are facing a lot of risk, both from a
uh
business
huh,
perspective, from meeting their targets, and from thinking about should they even have innovation platforms, right? So, and I know you
wow,
do a
yeah,
ton of work in
yeah,
innovation and risk and understanding, helping companies understand that. How do you how do you
yeah.
approach that? How should companies be looking at risk and de-risking their business and their portfolios and innovations today?
From a basic standpoint, the first is getting clear on what the context is. That's why we talked a little bit about sort of where are we at within the chemical industry. Because if you say no, we still got growth in China, da, 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 right? You're going to think about this whole space differently. So getting that context is the first piece of it. The second, and this is what we advocate, is look, you've got to reassess your portfolios. You've got to go through the portfolio, given a new context, and take a look at the fundamentals, right? What are the fundamentals that are driving each of your investment initiatives? And do they still hold up in the new context? We don't advocate for rules of thumb. It's not, hey, this worked last year, it's going to work this year. This is not the time to sort of use those types of rules of thumbs. You want to go back to what are the fundamentals of each of these investments? We think of sustainability in a couple of buckets, and they have distinct risk profiles. Okay, you mentioned earlier that you think, hey, the chemical industry has kind of always been about sustainability, hasn't it? Haven't we always tried to use less material to get costs down, right? Isn't getting material out of the reaction stream and out of the final product, isn't that part of getting the cost down? And that's really our first bucket. So things that are tied to efficiency, to productivity, to energy efficiency throughout the value chain, I think of as bread and butter sustainability. When I was a young operations engineer at Dow, in the division we were working at, the division manager wanted folks to focus on capital investments that also had environmental benefits, right? At that time, environmental was the
Right.
watchword of the day. And so they established a program for this, right? So you could get monies from a special pool if you focused on environmental impact, impact at the waste treatment plant, impact at the incinerator. We had all those on site. And it became one of the most popular programs. It was called the Waste Reduction Always Pays program, right? And what they found was you got a ton of payback
Right.
when you paid attention to how much wastewater you're sending to the waste treatment plant. You counted for that. You paid attention to how much waste you were sending and the cost of that. And as those capital programs started going, number one, they paid for themselves very quickly. But number two, the load on the waste treatment plant went down. The load on the incinerator went. All of a sudden, you see waste reduction and efficiency and productivity. You saw the connection to the financial benefit. That's the first bucket for us. To us, that's bread and butter. It's not going away. It may have been overlooked because of these larger sort of sustainability initiatives, right? But I think of things like lightweighting. Now we're electrifying and we're actually heavyweighting cars, but we used to be about lightweighting cars, right? Waste reduction, getting energy efficiency down the value chain. These are all, we think, the lowest risk bucket. Our second bucket, let's call it medium risk, is what I would put in initiatives around the circular economy. Right now, you could say that's part of the efficiency bucket, but the unique characteristic of circular economy is you're trying to build a value chain that brings materials back into the chemical stream, right? And yes, if you're doing that within a plant, that's part of the first bucket. But if you're doing something like plastics recycling or chemical recycling of plastics, this type of thing, you need to build a new value chain, right? That's part of the emphasis of a lot of these circular economy. We think of that as a medium risk bucket because and the way we think about sort of that is you want your circles in the circular economy to be as small as possible. And this is just a cost look, right? The idea being if you have to do a bunch of conversion steps from collection all the way back and you're taking the material all the way back into the value chain and then you're bringing it forward, chances are you've got a lot of steps. You've got a big ecosystem you're trying to build up. You're not going to have a big cost spread, right? To be able to get that value for each of your ecosystem partners.
Right.
Whereas if you design ecosystems that are smaller, that have a limited number of partners, and that have a more efficient recycle, you got a better chance of surviving. Right? If you want some examples of this, right? For me, at the one end, the big circle is something like chemical recycling through pyrolysis. You're essentially collecting plastic, you're aggregating it back in, you're turning it back into oil and then bringing it all the way back into the oil value chain at the refinery.
There's a lot of steps.
Right? There's a lot of steps there. And you're talking about producing commodities. Some of that's going to end up in monomer. Some of that's going to end up in fuel. One of the plays I like from a smaller circle standpoint is Eastman's Renew. So they have a chemical recycling. It's based on polyester technology. So here's an example where you can collect from the largest single recycled plastic stream that exists, right? PET. You've got very clean chemistry, and you're getting very high yields back to monomer. And then in the case of Eastman, you're putting it back into their high value copolyester business. So you've got a very small circle and you've got a very big spread to be able to fit that circle into, right? I think their biggest challenge right now still is capital intensity.
Mm-hmm.
And then you get to the smallest kinds of circles you can think of. I've got a company that I think is just a gem, a startup company called UBQ. And their hypothesis is I don't need collection infrastructure. I'm going to start at the landfill, and they have technology that will take cellulosic and plastic waste directly from a landfill and convert it directly into a usable plastic. About the smallest circle you can think of.
Yeah.
I think that one's got really, really high potential, right? And so you can see, in one case, you're like, struggling. And in another case, you say, wow, these things could still move forward even in the environment that we have today.
Yeah,
So those are the
absolutely.
buckets,
Yeah,
right?
that's useful. You talk about the landfill to whatever the bottles. What popped into my
Yeah,
mind is,
yeah.
Kendall, when I was a kid, and probably when you were a kid, we didn't drink a lot of soda. I don't know.
Uh-huh.
Maybe it was the sugar. It was not as available. It was expensive, but we'd get 8 packs, remember, in glass bottles. And you'd
Oh,
return the
yeah.
glass bottle, and the glass bottle got washed and refilled, and somehow along the way we've gotten away from that. And frankly, some of it's lightweighting. It's the beauty of plastics. It's the way the markets have changed and stuff.
Yeah.
But we've made those circles a lot bigger than they used to be.
I mean, I remember as a Boy Scout doing paper drives, right? That was when paper had value on the market. And so you were I had a reason to go out and ask people for their newspapers because
Right.
I could sell it and make money for it.
Right.
Yeah. So those are the buckets. In terms of the reassessment, I talked a little bit about the reassessment. So we think of reassessing against 4 criteria. And part of this is about getting really brutally honest about your initiatives, right? Take each one against 4 criteria. One is, what does your initiative look like in a cost constrained environment, right? If you're selling biopolymer competing with polyethylene, that may have all been well and good when polyethylene was selling for 80 cents a pound. How is it now if polyethylene is selling for 60 cents a pound,
Yeah.
right? Does your value proposition still hold water? And the other piece is in a capital constrained environment, right? If you've got somebody who's going to have to make an investment in order to grow the product you're trying to sell, how are you holding up if, let's say, that those capital investments are going to be very difficult to get, right?
So, Kendall, I want to
I think those
interject.
two are super easy. Yeah,
Yeah,
go
I'm
ahead.
going to
Yeah, go
interject
ahead.
here with a bit of a philosophical discussion that I did not tee you up
Yeah.
on. So here we go. Because part of the challenge here, and I think it's a dilemma that we're facing in a global world with legacy companies, is we are operating with different measures. So I look at, for instance, we talk about, let's just take polymers, polyethylene, pick almost any somewhat basic chemical. China is overbuilt. China is overbuilt, and they're
Yeah.
not going to stop building, and they're going to keep building, and we are awash with
Yeah.
polyethylene, polypropylene, other stuff. I contend, those companies are not publicly held companies, or maybe they are, they're quasi,
Yep.
whatever.
Yeah.
They
Yeah.
are operating with a different strategic plan, a different set of metrics.
Yeah.
They are clearly operating on a country strategy that is the China first strategy around independence. And then we've got companies in the US and Europe, and particularly, let's just tackle Europe, where we're shutting down because it's not economical and they can't compete. It can't meet the stringent environmental requirements. So what it strikes me, and this is a bit of maybe my philosophical question, is, and I don't have an answer, but should companies be setting, what percentage of their business should they be setting that, this is just our long-term investment. We know there is no return for the next 10, 20, 30 years, but this is what it takes for us to be in business in 50 years. Because if I keep shutting down and rationalizing and not making investments, because it's efficient to do so, and I save money today, and my stock market investors are happy, I'm actually out of business in 30 years.
That's a fantastic. So this could be an interesting conversation just in and of itself.
Yeah.
So this is why sort of getting clear on what we think the China dynamics really matters. Okay, and trying to see forward the fundamentals of, can they continue this, right? In the last 20 years, it's been, no, that'll never work. Central planning doesn't work, right? You and I both probably you're a Texan, you come from a free market kind of background. I come from the same type of background, right? And you got to the point with that Asian growth cycle where you said, maybe there's something to this. Maybe we should be doing what they're
I
doing.
mean, let's learn from history,
Um,
right? I mean, if you look at
yeah,
history,
yeah,
the long growth cycles and the long commitments have worked. Maybe not in short term,
right.
but on the long term, they do work.
So the one way to so as you look forward, then you say, are these fundamentals set up to operate like this going forward?
Yeah.
And I think there's two things that really suggest that the China thing is over, is structurally over, and in a way, it's a vindication of the central planning, the naysayers, if you will. Number one, they've imploded their real estate sector. And I don't know how much people see that or feel that here because it's localized,
Yeah.
right? But you now have local governments that are highly in debt. Most of the Chinese who could not get their money out of China, many did, right? Vancouver's overbuilt. There's lots of places that are overbuilt, but most of the individuals who could not, guess what? Real estate was a great investment. And it's a way that you can invest, families would get together and they would buy apartments, right? On the bet. It's a speculative bet. Hey, this is all going to work out. It's worked out in the past. It'll work out in the future.
Right.
And so what you have there is a significant amount of capital destruction. Okay. The other piece that I think people aren't quite aware of, and this is really fundamental. So this says, okay, can you restart that engine?
Yeah.
Right? Does that engine restart? Does it continue to work? So they imploded the real estate sector. They've overbuilt their fundamental materials sector, right? The other factor that you have is China is in the early stages of a population collapse.
Yeah.
So their population has been flat for 3 years. That's unheard of. And if you look at estimates right now, if you look at estimates using official figures, it's something like they're going to be back to 700 million people, not the 1.4 billion people we thought they had. When that starts to happen, and if you look at, a lot of the population figures are a little bit overblown, and that's starting to come to light now, and it makes that population collapse faster and deeper and worse. As that starts to happen, you now don't have people to consume, right, in the same sense, and you don't have workers to operate factories in the same sense. So you got here by being the low cost manufacturer, and now your supply of manufacturing labor is drying up, coupled with the fact that you've got to restart that with capital. And the one thing I know about free markets, and some of the capital was coming from the free market, right?
Yeah.
Eventually foreign direct investment came in. You fool me once, shame on you. Fool me twice, shame on me, right? And so I think fundamentally you've got some structural issues that say this is not coming back.
Mm.
Now, how do we deal with the fallout? Because they're already overbuilt. So if you thought, go back to the way you used to think about chemicals. When there was a cycle, we would get pretty pissed at the guys who were the last ones to build a cracker and didn't see the cycle coming. These were bad actors, right? Or the guys who decided to trash price because they're going to get into a price war during the cycle, right? These were the bad actors. And these are stigmatized folks. And the market essentially works those out, right? The good players within the market understand you've got to build capability. You can't overbuild. You've got to be smart about the cycle. And so what we have, you can think about this if you think about a global market, what we have is a bad actor who is operating on their own policies. And if you're doing that with your own money and your own people and your own assets, that's fine. If you're going to blow up your own real estate sector, have at it. But what you now see China trying to do, and they're doubling down on the consumption policy, which is we're going to sell our excess capacity on the open market. Right? And we're not going we don't want to slow down. We want to continue. So you've got somebody who's now socializing their bad acting into other markets. Well, if you remember, we originally let them into the WTO on the basis of their liberalizing and moving toward free markets. So now they're taking actions that show that they're not. So you could say, let's do what they do, but we know where that's going to go. I think this is a time when you start to say, look, these were the basis on which you were allowed into the global market. This is a place for policy. This is a place for government action to say, look, if what you're going to do, given that place in the global market, is overbuild and then socialize your policies to the rest of the world, Do we really want that to continue?
Yeah.
And would we stand for
Yeah.
that?
Great topics.
Right. And I think that's some of what you see in the political backlash today.
Oh yeah,
Right.
and
That's
there's
some of
and we
what you
won't get
see.
into politics because that's its own
No,
morass.
no, no.
But what I am going to say while we've got this, we're on this topic is John Richardson from ICIS has been on the show a number of times, and we've talked about some of the China dynamics.
Yeah, love him. He's great.
I will link some of those episodes here in the show notes and to the blog so that we have people have that context if they want to go do some research.
Yep.
All right, Kendall. So
Sure,
we're
sure.
going to be running out of time here. Maybe
Okay.
my one final question that I've got for you is, so as you sit here, we're the start of 2025. We recognize that there are some dramatic global shifts taking place, just economically, socially, et cetera, and companies are really assessing and figuring out what their next steps are. What's your top 2 or 3 things advice that you give to executives who want to manage and grow?
I think the first step is reassessment, right? We're in a period of pulling back and rationalization. So you've got to do a reassessment, and you've got to do it on fundamentals. Step number 1. Step number 2 is the sort of easy options for growth. The easy levers for growth aren't going to be there moving forward. I give you an example. I worked for 2 companies during this time, this heady time of growth, if you will, and they grew by acquisition. Both of them. There was a big acquisition spree. They grew by acquisition. And it was this sort of thing that when an acquisition was over and you sort of got through all the synergies and you were looking at counting on your organic growth to continue the growth path, you weren't always there, right? And as long as you're managing the core business really well, you could always go get financing and do another acquisition. So in the past, I would say managing your core business and then being able to trade on your core business was a fundamental. If we're going into a cycle, everybody's going to be struggling to manage their core business, and they're going to be looking for growth wherever they can. And I think we've gotten soft on capabilities around organic growth, right? We've been doing that for so long in this era that we've gotten soft on our capabilities. And so the second thing that I would say is you've got to invest in your core capabilities to do organic growth.
Got it.
Right? And that means being able to do market-driven innovation, right? And having the commercial capability for new business. And when I say that, I think we've gotten very used to managing existing accounts commercially, marketing to existing accounts commercially, and we've lost some of the muscle that we had to go out and get new business, to launch new products. I'm going to say something that's going to be heresy, probably I'll get in trouble for saying it, but I don't think the epicenter of B2B commercial excellence is in industrials anymore. Right? When you and I grew up, if you wanted to do B2B industrial commercial work, you went to work for GE. You went to work for Dow Chemical because those were the places that knew how to do this the best. I think the epicenter of commercial excellence today in B2B is in tech. Right? And in a sense, we've fallen behind. Tech is not afraid of digital, and tech has kept up with the selling science. The selling science has advanced. I used to be a huge value selling guy. I am a value selling guy. Value selling is table stakes. Solution selling is table stakes.
Yeah.
And if you're not up on the latest science there, you'll end up falling behind. And if you're not using the latest tools, you'll end up falling behind. And so that's the second piece of it, right? Growth is going to be hard to come by. You've got to start investing in real organizational capability for organic growth.
I love it.
And that's what GrowthArc is all about.
Cool. I love it. And that's a great close. So Kendall, this has been really fun. If people want to connect with you, how can they find you?
Absolutely. 2 ways. Number 1, I'm all over LinkedIn. So if you're a LinkedIn user, feel free to connect with me on LinkedIn, and I've got a company page on LinkedIn as well, GrowthArc Advisors. If you're not, and I know there's a lot of people who are not, right? I would say go to my website. I'm at growth-arc.com, www.growth-arc.com. I run an executive roundtable. I run a newsletter. I would say subscribe to the newsletter, and you will hear and get some of these perspectives and be able to stay in touch and join into the dialogue as well.
Love it.
So,
Kendall, thanks so much for this. And thank you, everyone, for joining us today on The Chemical Show. Keep listening, keep following, keep sharing, and we will talk with you again soon. Thanks for joining us today on The Chemical Show. If you enjoyed this episode, be sure to subscribe, leave a review, and most importantly, share it with your friends and colleagues. For more insights, visit thechemicalshow.com and connect with us on LinkedIn. You can find me at Victoria King Meyer on LinkedIn, and you can also find us at The Chemical Show Podcast. Join us next time for more conversations and strategies shaping the future of the industry. We'll see you soon.